Whether a private investment is right for you has less to do with the merits of the actual investment itself and has more to do about your specific situation. So as a business owner, you're getting pitched all the time on investment opportunities, whether they're startups or real estate. Look, there's over 100 million buildings in the US. So we're seeing deals all the time. Business owners are always being pitched these things. But what you really need to be asking yourself are three fundamental questions, not just, is this a good deal, but is it a good deal for me? And the first one that we see most often looked is the liquidity trap. So let's take the example of a building. I take a retail building, rehab it, fill it out there. You can do multifamily, whatever you want to think about here. What you need to be looking at is how much money is required from you upfront, how much money is going to be required in the future. Are there additional capital calls potentially? How long is that money locked up as well? And that leads back to the question for you is, am I better off investing in this project, the cash flows as they're associated in, or am I better off investing in my business, opening up a new business, or looking at other opportunities? How long is that money tied up? So liquidity is a critical factor here because very often we see business owners' financial plans go wrong because of liquidity, not investments. So being really focused on liquidity, that's the first thing. The second thing that we need to be focused on is, do I have too much concentration risk? And we recorded a previous video on talking about concentration risk with business owners, but let's use the example of a client that we work with. They have a commercial building, and that commercial building pays for more than their needs and their wants. That takes care of them in retirement. They've actually taken that money they've made from there and since gone and bought an apartment building. And that apartment building is growing for a future generation, and it's also kicking off additional cash flow to now invest in new opportunities. So we, the advisor, when we look at their situation, we're sitting here saying, okay, there's a commercial building over on the East Coast. Now there's over one on the West Coast. We have an apartment building here. They're kind of in some core primary cities, okay? So great locations. What opportunities can we present to them that complement these two core assets? So kind of think about it, what's often referred to as a core satellite approach. So we're looking for opportunities. We're saying, all right, look, we think you could do $250,000 in this industrial building. We're looking to double your money in the 3 to 5 years. Yes, there's associated risk with that, absolutely. But we're also in a new market and a new asset class type that you don't have exposure to. We're really kind of complementing your core holdings that you have. You need to be thinking about that as a business owner is, am I overly allocated to just one vertical, or do I have a nice broad diversification? Is this helping me with my diversification? Is it helping me with my liquidity as well, as we talked about earlier? Third and final thing is that when you're pitched a deal, that deal lives in a vacuum. Nobody thinks about your individual tax consequences. So we'll see this often with prospects where they'll say, I have an opportunity to invest in this building that's going to pay me these cash flows along the way. And we'll look at it and say, okay, totally understood. But because of how the building's structure or this or that, what we need to be considering as well is the income that's going to come off of that building. It is going to decrease your ability to do Roth conversions. Now we're going to have RMDs in the future at 35%, where we could have done a Roth conversion down here at 24%. So yes, it's a good building. Yes, it's a good private investment, but it's not a good private investment for you. And the reasons why, again, why an individual deal may be a good investment on a standalone basis, but not right for you as a business owner is 1, liquidity, 2, not giving you the diversification, too much concentration risk, and the third being is the unintended tax consequence of that investment. Thank you.